Okay, good morning, still morning, everybody. We will start in a couple of minutes. I think I will wait a couple of minutes for the others, as there is very few of us, only 6, and so I will start in a couple of minutes. Okay, I think we can start. So again, good morning to everybody. And well, last time we have discussed different types of owners and shareholders and stakeholders of a company. And well, so the majority of companies we know they have dispersed ownership due to different reasons. So first, the individual investors are quite small relative to some companies. And this is the effect of economics of scale. The main care for individual investors is and the main motivation for individual investors to invest in a company is risk diversification. Yes, so they create the portfolio of their investments to avoid their unsystematic risks. So you remember that there are two types of risks, the unsystematic risks and systematic risks. So we cannot avoid somehow the systematic risks, they exist, and we consider them but we cannot actually avoid or eliminate totally the unsystematic risk, the specific risk, by investing in different assets. So that means that individual investors should invest in different types of companies in different industries, so to diversify their risks. Also, investors are caring about the liquidity of their shares because it's usually difficult to sell a large stake. So they prefer smaller stakes in different companies. And certainly there exists an owner-manager problem because first, usually the small shareholders, they do not contribute a lot to the company's performance, to the company's governance. And because they do not have a lot of information, and the cost for getting an access to the information is quite high. Sometimes they should pay for getting the information, so sometimes the companies disclose what they should disclose, again with to the disclosure requirements. But anyway, it is quite difficult for them to get the whole amount of information. So that's why the cost of getting information is quite high. Also, there is, and if they do not participate too much in the governance, if they do not exercise in a proper volume their governance rights, so they just share the benefits and the risk also of the company, the profits and losses without an active participation. So there is like a free rider problem, yes? So they just ride the horses without any payments expressed in their active contribution in company's governance. Yeah. And there is also the conflict of interests of owners, so it makes difficult their collective actions in relating to monitoring the managers. And if, for example, the large investors are not satisfied by managers, they sometimes prefer just selling their stock than trying to exercise their rights. So this means that exit is more preferable than voting, than the exercising of their voting rights. Certainly, it is not the case of activist investors we have discussed last time, but it happens many times. So there is no one-dimensional solution on which stakeholders will be the best owners, and certainly it depends on different factors like their culture of the company, so traditions, values, norms, and preferences of shareholders, of stakeholders, also the technical conditions within the company, the situation on the relevant market, and also the institutional and regulatory framework that constitute the benefits and cost of ownership, and alternatively to ownership of market contracts for the possible stakeholders. And certainly it also is defined by stakeholders' resources and interest in for acquiring and performing formal ownership rights, and appropriated rights that are compared to market contract. Yes, so either you are the owner of the company, or you are in the other types of relationships with the company, which can be defined as market contracts. And certainly for different companies in different markets, the optimal structure can be different. For example, in Japan, where we have usually the Keiretsu-based economy, so the optimal structure of ownership will be very much different from the optimal structure in the United States, where the equity funding is the main source of companies' funding of companies' capital provision. Yeah, so how the theory, what does the theory tell us about this, the optimal structure of ownership and the optimal stakeholder relationships within the company? So it starts from the new theory of the company that has been, of the firm actually, that has been developed and proposed first by Ronald Coase in 1937. And as you remember from this book, actually, Ronald Coase proposed that transaction costs are the main rationale for the company's existence. Yeah. Later, in organizational economics framework that has been developed by Williamson and later Jensen and Meckling, the company as a firm has been viewed as their governance mechanism. And certainly the transaction or the agency costs were caused by information and incentive problems. And these costs actually were the main boundaries for the rationality and the opportunism. So, and later Hart specified that transaction costs lead to incomplete contracts and to the residual counter rights. So the market contracts are incomplete. They do not have much incentives for their stakeholders to realize their rights. That's why they somehow can prefer the ownership, the residual control rights. And the companies and the agents, they always should trade off between their ownership and their organization to minimize the transaction costs. And the focus is on the informational asymmetries and the asset specificity. So their type of the market, the type of information asymmetry, and also the specifics of assets also make the main sense for different types of stakeholder when they choose whether to become the owners of the company or whether to keep some contract relationships with the company, the market contract relationships with the company. Yeah. And later there it has been developed through their contract failure reasons, and the theory of ownership has been explained by the contract failure. So Huntsman explained that the efficient ownership should minimize the transaction cost. So transaction cost consists of two parts. So first are the costs of ownership, and the second part are the cost of market contracting. So we always should trade off these two types of costs and make our structure of ownership structure in a way to minimize the total transaction costs. And later, also Mygent proposed to include some specific stakeholder benefits, as for example, it could be higher wages or secure jobs for employees. For strategic investors, it can be the benefits of economies on scale, or it can be the possibility to increase the market power and to exploit the market power position. So when we discuss the transaction costs, as I have said, they consist of two parts. So first are the market contracting costs, like the costs of negotiating, formulating, and monitoring a contract. Also the market power in relation to different types of stakeholder. For example, the stakeholder is the supplier or the customer. It has some market power over the company, but the degree of this power certainly differs depending on the type of stakeholder, and also the asset specificity that creates the hold-up problems. So with different types of assets, it's better to hold them, or it's better to keep them, not to hold them for a long period of time. As for the ownership costs, so the main cost is the cost of monitoring the managers, and also there are two other types of costs. So first is the collective decision making among owners. So less owners, the more power they do have. Easily either is to make the decision, but also there can be conflicts even between the major stakeholders and the major shareholders. So to mitigate these conflicts, it costs and it creates some costs. And the third type is the risk bearing that is connected to the residual rights. So certainly when you become the shareholder of the company, the owner of the company, you not only enjoy the benefits of participating in profits, but you also can bear losses that are created by different risks, and you also participate in these risks. So these are your costs of being the owner of the company. Yeah. And certainly the governance, the corporate governance structure is adjusting to the different types of markets and also to the changes on the market that occur all the time. So everything is changing. Yes, the technology is changing, the market structure is changing, the institutions on the market are changing, etc. And it leads to the change of the optimal governance structure. So we cannot fix the governance structure forever. And certainly the main recommendation is to diminish the barriers to change. Yeah. So if the environment is changing, the governance structure should also change easily according to the changes of the business environment. Yeah. So how we can diminish the barriers to change? First is to increase the transparency. Second, to diminish barriers for shareholders' voice and for shareholders' exit. and also there to diminish or to eliminate totally takeover defenses. So it creates their decrease of agency problems, they become less. It leads to the growth of share prices, and it becomes easier to mobilize capital, both debt and equity, yeah, because both types of capital depend on the corporate governance structure and on benefits of corporate governance. But from the other point of view, it leads to the unstable stakeholders relations, because the structure is changing, the role of different stakeholders are changing, and there is the instability related to the stakeholder structure and stakeholders relationships that can create additional costs. Yeah. So we have discussed the transparency. We have discussed previously the barriers for shareholders, voice and exit. What we did not discuss in details, but we touched this also, are takeover defenses. So why takeover defenses create additional costs? In general, they make the company more expensive, and they actually create the costs for both managers, shareholders, mostly shareholders of the company, and the outside potential acquirers of the company. Yeah. So what are the main type of takeover defenses and what types of costs they cause? So the first type is to delist the company somehow, so to make it private. So usually it is done through delisting. So the company stops to be quoted, to be listed at stock exchanges. It prevents from the takeover, or it makes takeover much more complicated. Yeah, but from the other point of view, it creates additional costs for shareholders, yeah, because the access to capital becomes more complicated and the cost of capital increases. And certainly the transparency is diminishing. So that means that investors actually trust less to this company. So the other way is the leveraged manager buyout. Yeah, that means that the manager the company want to take over and to prevent themselves from the disciplining power of the market, of outside takeovers. So what do? Usually they attract debt, it's mostly debt, from the specific funds, yes, that are actually focusing on leveraged buyouts. And using this debt, they buy back shares from their company, and so they from the market, sorry, and they become the main owners of the company. So it increases the managerial power. It somehow decreases the cost of ownership. Yeah. But from the other point of view, it increases the debt for the company, and it makes the company more risky, more expensive, and less sustainable. Yeah, the third type of the same defense is employee stock ownership plan, that actually makes the employees of the company the main owners of the company. Again, it increases the managerial power. It makes the costs of decision making less. But from the other point of view, it decreases also the access to the external capital and makes the company more risky and more expensive. Yeah? So this is the first type of defenses. Yeah? The second type is that the company that faces with the threat of the hostile takeover on the market is finding a white knight. So the white knight is an alternative investor that claims its friendly attitude to their company, and just comes and well, acquires the company. Yeah. So usually the friendly investors, this white knight, signs like an agreement that in some period of time, usually 3 years, they would not interfere the operational activity of their company they had acquired. Yeah. And it prevents managers, so actually it secures the job positions of managers and prevents them from losing their positions, so they are much more safe. They can, from the one point of view, they can continue their activities, but if they were performing not well and the company was not performing well, so there is no incentives actually to the managers to improve something, because their investors, they just own the company, but they do not participate, they do not have any power, so they sustain themselves of interfering the company's activity. So so I can give you, I think, a couple of examples of these white knights. So one case is from Russia, actually. One case is from Russia, so this is Ilim Group, or Ilim Pulp. Actually, this is one of the largest Russian companies in producing the pulp paper, some forestry resources. And Ilim has been for 3 years in a severe corporate war with Basel. So Basel also, so Basel is a conglomerate. It is the main owner is Oleg Deripaska, and Basel was very much focusing on this market. Actually, they were in the state of war with Ilim. It was sometimes very cruel. War with kidnapping, with some other illegal actions, with the treatment of the regional authorities and so on. And finally, Ilim managed to stop this war by calling their American company, American paper, and they signed an agreement with an American paper that American paper will acquire 50% of stock of Ilim, of shares of Ilim. And then American paper signed an agreement that they would not interfere with the company's activity for 3 years, as usually. So they acted as a white knight. And after this, actually, everything finished, everything went quite good for Ilim. So they stopped the war with Basel, because Basel could not beat American paper with its resources in this period. And till 2014, everything was okay. Later, when the special law has been implemented in Russia that foreign investors could not have more than 20%, so American paper sold their stock to the managers of Ilim. Yeah, so this is a good example, I'd like to say. The other case of white knight was taken place again with the Russian company. So this Russian company was Severstal, and this case relates to the case of companies we have looked at the seminars. So specifically it's ArcelorMittal. Yeah, so you know that the ArcelorMittal has been created by their takeover of Arcelor. It's a Luxembourg-based steel company. By Mittal Steel. So Mittal Steel, you know, it's the Indian group. The main shareholder and the major stakeholder is Lakshmi Mittal and his family. So when the first proposal has been made by Lakshmi Mittal, tender offer to the board of Arcelor, they rejected it unanimously, and then Lakshmi Mittal has made a tender offer to the shareholders of Arcelor. And they also rejected this tender offer because they considered that the company was undervalued and the price that has been proposed by Mittal was low. So there was some premium, actually about 12% over the current market price. And the second reason why they had rejected this offer was related to the bad ESG reputation by Lakshmi Mittal. So you have already read about his issues with pollution, with workforce, and so on. So they did not want to deal with their company with such negative reputation. And what has happened? So meanwhile, Severstal made their own offer to Arcelor, and they signed an agreement actually that the offer was a little bit larger, the price was a little bit larger than the one that has been proposed by Mittelsteel. And they actually were ready, and they signed a preliminary agreement that they would act as a white knights. So they claimed that they would not interfere the company's activity for 3 years, and they just will participate in profits and profits, mostly the dividends that would be paid. But finally, so it was almost signed and almost ready, but there were actually two factors that made this deal incomplete. So first, there was a strong support by the Russian government, and the shareholders of Arcelor were a little bit frightened by such an active support, to tell the truth. And the second factor that Mittelsteel, they proposed a new offer with a larger price. So finally, the shareholders of Arcelor, they agreed with the second offer. And they paid actually the penalty, the fee to Severstal, because they breaking off their agreement. Yeah, so this is the second case. But sometimes white knights, they do not keep their promises. Yeah, and the example of such a behavior is a Chinese company, Midea, that has acquired the KUKA. So KUKA is a robotics company based in Germany, and the acquisition has taken place in 2017. And Midea also proposed themselves as a white knight to KUKA. So they just proposed that they would supply KUKA with capital. And for them, as a Chinese company, it was just a very good action to be presented at the European market. So KUKA is a large company on the European market. But after, and they actually signed an agreement that they would let KUKA to be managed by their existing managers. But KUKA did not perform very well, to tell the truth. And just in a year after the acquisition has taken place, Midea, as a major shareholder, replaced the chief executive officer of KUKA, and actually made some huge changes in the company's management. It did not help a lot, so KUKA is still underperforming, and this deal can be recognized as an unsuccessful one, but it just tells us that actually the white knights are not always so white. Yeah, but this is a very popular type of takeover defense. This next is poison pills. So the poison pills are different types of securities, of derivative securities, that make their acquisition more expensive. For example, it could be the preferred shares that are distributed between the existing shareholders of their company that became the target or the potential target of the hostile takeover. So to buy the company, the acquirer should buy also the shares, and it makes the company more expensive and less attractive for the acquisition. Yeah. Usually all these poison pills can be created by managers without the approval of shareholders, and actually the shareholders pay for all these new securities, so it's additional cost. Yeah. The fourth are golden parachutes. We have discussed golden parachutes already, and we know that they make managers more safe. So they are just securing their jobs in the case of their takeover, or if they do not secure their jobs, so the company bears losses because they should pay these golden parachutes. Yeah. The supermajority for accept of takeover bid means that instead of 75%, which is usually the normal situation when shareholders, a qualified majority of shareholders approve the deal, in many charters, in many corporate charters, we see another figure. So more than 90% of shareholders in the case of takeover should approve the deal. And it makes actually their takeover less probable and more costly for acquirers. Yeah. And also the staggered election of the board means that only 1/3 of the board can be re-elected each year and can be changed each year. The others should be just at their places, and it makes the takeover less sensible, yeah, because if the acquirer wants to improve their company's performance, and for this they should make any some decisive actions, and we know that these actions, they somehow should seek their approval from the board, and the board cannot be changed quickly. So the radical changes are less probable, and it makes the company less attractive for the future, for the potential acquirers. Then dual classes of voting shares, it's also very common, mostly for the American companies. And you have already faced with these dual classes when you looked at their cases. So you know that in many American companies there are two classes of shares. Somewhere there are three classes of share, A, B, C, but in majority of companies we have only A and B. So A class shares are the usual common shares, one vote per one share. And the dual class, the B class shares, they have the same financial power, but a larger number of voices, usually 10 voices per one share. And certainly it makes the acquisition much more complicated, because the acquiring company can buy the shares, but they cannot get the approval of shareholders, or even if they make the acquisition, they still will be not in the majority, they will be in the minority at the shareholders meetings and also within the board. That makes the acquisition less sensible. Yeah. Also, there can be the restriction on foreign ownership of shares, mostly for the state-owned companies. So we looked on the case of Embraer, and in the case of Embraer, we had the situation when there and in many other companies also. So only some limit of foreign ownership is accepted, is permitted. For example, in Russia, in strategic industries, only 20% of foreign ownership is permitted. Yeah. And also the cross-shareholdings. So cross-shareholdings means that while the takeover company, the bidding company is going to make a takeover, their other company, the target company, has also some ownership in their bidder company, and they can just make like a tender offer to prevent the takeover. This type of defense is called the Pac-Man defense and is quite rare, but still exists. So all these takeover defenses make the company, so the probability that the company will be taken over from the market less, but from the other point of view, that means that the discipline and motivation for managers, so if you do your job not in a proper way, if your company is underperforming, it would be taken over. Yeah. So this motivation is diminishing, and the managers, they can just do what they do without any fears. Yeah. And certainly this causes additional costs for their shareholders, because the company either bear losses or the returns that shareholders have, they are less than the market, the opportunity cost of capital, the market hurdle rate, or they just are bearing additional costs created by these takeover defenses. Yeah. Okay, so let's look at the different types of ownership or market contracts and the different types of stakeholders and the different cost of benefits of two types of the relationships with the company. So either they act as the owners of the company or they act as the market contractors of the company. So the employee ownership, so if we look at the employee stock ownership plan, which is the main form of employee ownership, so what benefits it brings to the employees? Mostly the wage flexibility, so when the company is performing well, the wages can go up. When the company is not performing well, does not perform well, so the wages can be sustained, and this will be the decision by employees because they work and they act not only like employees but also like the owners of the company. From the other point of view is the job security. So if the employees are the owners of the company, they very unlikely will reduce their jobs, job positions. Also, they have plenty of work incentives because they are carrying on these work incentives, they are carrying on the company's performance. And self-governance, so they are the owners of the company, so they act as the owners of the company and they care about the company's performance and they can make the governance by themselves. So when it is important? So when we have the market with high cost of unemployment, with the high cost of human capital, and with the high priority of voices over the exits from the company. So what are the main drawbacks, the main costs of employees' ownership? So the first is the cost of capital, because the market, actually they do not trust a lot to these companies, and the costs of attracting additional either equity or debt will be higher than of the public companies. Also the risk concentration, the decision making, so the decision making becomes less transparent in this case, and some information costs. So the high risk, there could be conflicts within the employees, and sometimes this form does not require the high managerial skills. If we look at the employees at the market contractors, so we deal with a fixed wage, and this means that the wage flexibility is low. So the specific human capital resources are restricted. There exists an agency problem between the employees and the managers, between the employees and their shareholders of the company. And it is important when there is a low need of motivating and bonding labor force, and when the exit is more important than the voting power. And whereas the labor, the high risk, high need to avoid the labor risks. So the main barriers to such form are the lack of capital, lack of skills, and lack of experience, and this is very important. So not many companies, they prefer this ESOP form, but there are the main drivers as the motivation of high human capital, also job security, self-governance, tax incentives, and privatization support. When the company is going privatized, it's very important that the employees become acting as the shareholders of the company. So mostly to which types of enterprise it's the best form. So these are professional enterprises, are quite small with low capital intensity. Their employees are highly educated and more or less their structure is homogeneous, and high specific human capital is also important. So mostly for specific cultures that require the active participation of employees and companies managers. And as I have said, ESOP is a very popular action as a takeover defense. If we look at the managers as the main owners, so I have said that the managers, MBO, management buyouts, are very popular as a takeover defense measure, and managers become the main owners of the company. So, or they are the main owners of the company from the very beginning, and they still stay the main owners of the company. So the main benefits are the work incentives, so they are caring about the company's performance, yeah. Also self-governance. As for the cost of capital, they are usually high because their company is non-public. In this case, or it's less transparent and the outside investors have less rights or less opportunities to exercise their voting power. And certainly there is a huge concentration of risks because the owners are the managers and they have quite large stock holdings. It's important when the company has high requirements to human capital, and also the main factors are high capital needs and high risk. So when managers are acting as the market contractors, they are on salary. So the agency problems arises, so manager-owner problem. But the diversification, so they can secure their investments, yes, by acting also as shareholders and having the opportunities to invest in different companies. So it is important when we have the low transaction costs, the high transparency, when the market is defined by managers, and this is a strong stock market, and the managers try to averse risk. So the main barrier is the lack of capital, because the market, the cost of capital are going higher for these companies, these types of companies. And the main drivers are when outside ownership creates strong governance problems. So these are the main drivers, and that's why managers take company over. Also unstable markets, weak institutions, and also when the information is highly asymmetric. So all these factors lead to their incentive for managers to become the main shareholders and to get the company over its direct governance. Yeah. So if we look at the most common types of enterprises with managers ownership, so usually these are quite small companies, mature with low capital needs. This is also very tightly connected to the entrepreneurial culture, when the founders of the company become the managers of the company and still control the company through the ownership. Also defensive insider takeovers happen, I have told you. And often these companies are employee owned, but managers control the enterprises. Yeah. Okay, so the next type of investors are, I'm sorry, venture capitalists. So when, sorry. Venture capital and private equity funds. So, well, you remember that venture capital firms, they mostly invest in companies that are underperforming, so they are less valued by the market, but they have huge or high potential to grow. And the growth is the main driver for venture capital to be the shareholders, the investors of these companies. And mainly venture investments are direct investments into the equity of the company. So they become the equity investors at the earliest stages before the company goes public. Yeah. And they usually have their representatives in the board, and they also provide the company with all types of advisorship and consultancy. So the main motivation for venture investors to become the owners of the company is to participate in the profits of this company. So usually they get all their profits. Actually, this is capital gains, not like the profits, when the company goes public. So when the company goes public, when it makes the IPO, venture capital funds, they sell their shares, their equity holdings in the company, and that's why they get profits. Or they can stay as the minority investors for the longer period and then get profits from their dividends and capital gains. So they somehow diversify their profits. Or when the company they invested in is acquired by the strategic investors. So in this case, they also sell their shares and get the profits. So potential profits are the main benefits for venture investors to become the owners of the company. Also, they have an informational advantage and the managerial advantage because they are in the board, and they actually can reject some initiatives of the managers of the company. They have this right to reject these initiatives if they consider that the initiative somehow will destroy the value or somehow will threat the growth potential of the company and so on. And they have the good access to the whole information as the company report also to the venture capital funds. And certainly capital staging is also the benefit for them. Because they provide capital according to the company's performance. So if they consider that the company in rounds, so if they consider that the company they have invested does not perform well, they just stop the investments and the company should improve. Prior venture capital investments will take a decision to continue the funding of the company. So if venture capital funds remain not like investors, but the market contractors, so they usually provide some loans and bonds to the company. So this is the debt type relationships, which is quite rare for the venture capital funds, but still exist. And in this case, they have the agency problem because they are not secured. They do not participate in boards, so they do not have an access to the information. And there is a problem of relationships with managers of the company. And certainly the company can fail. And there is a problem of debt failure. So it is important when actually this is not like their common type, but sometimes it's important when there are other factors are not relevant. So the main barriers are takeover defenses, the core ownership for their venture capitalists, so they should participate in the ownership structure. And the main drivers are the access to different types of resources, not only Jose, it's better late than never. So the main types, so they get an access not only to the capital, but also to the governance skills and to the information, to the managerial skills. So actually, there are main drivers for venture capitalists to become their owners of the companies and for the companies to seek their venture capital ownership. So what are the most common types of enterprises? So usually these are the companies that are underperforming but have the huge potential to grow. So they are cheaper, but they have potential that can pay itself. Or this can be the startups or the new enterprises in specific industries when the industry has the potential to grow or is promising to have this potential. So usually venture capitalists, they invest in such industries as high tech, as pharmaceuticals, biotech, fintech now, well, and something else. That these industries are promising to shape the future of the markets, but still are underperforming for now. Okay. So portfolio capital ownership or market contract. So we remember that portfolio investors, they actually invest in different companies to secure their required rate of return. So their main motivation and then main drivers actually for them to become the owners of the companies are potential profits, certainly, and also the risk diversification to mitigate the specific risks. So usually these are important for well-functioning stock markets, yes. So when the stock markets are highly developed and the portfolio investors can invest without additional costs in different types of companies. If portfolio investors remain like the market contractors, they also can provide loans and bonds, buy bonds of the companies, and the problems are the same. So this is an agency problem due to the weak protection of bondholders or the debt failure of the companies they had provided with debt. So the main barriers are weak stock markets. When on the weak stock markets, we do not have the diversity of the companies where portfolio investors can participate, and also the block holding ownership. Yes, in different ones we have the block holding, so there is less rights for portfolio investors, and they can not gain the gains that they are aimed at. Yeah, and the main drivers are resources. So the company has an access to the resources, and the portfolio investors, they provide some risk capital because they specialize on different types of companies. So usually portfolio investors and most appropriately they prefer blue chips. So blue chips are large companies with good liquidity of their shares that are traded at several world stock exchanges, and they are quite mature and have the high capitalization. So it reduces the risks for portfolio investors and make the diversification easier. Yeah, okay. As for the bank ownership, so again, we know that sometimes in some models, banks are the main shareholders of the companies. So usually the bank ownership brings such benefits as a synergy with creditor role. So when the bank sees that the company needs some external resources, they can easily provide the loan to the company and get synergies. So from the one side, the company is developing better, it is provided with resources, so as shareholders they are quite happy. From the other point of view, they get their interest payments and they get some satisfaction of their lenders' rights. Yeah. And the second motivation is the risk diversification. Yeah, so they easily can create the portfolio of their holdings. Yeah, so it is important when their banking system is universal, because in this case, the universal bank can provide both equity capital and the loan capital for the company. And that's why in the United States, banks are quite rarely the investors of the company, because they are not universal. So in the United States, we'll have commercial banks and investment banks as separate entities. And that means that they cannot enjoy this synergy. If banks create just market contracts for the company, so they provide only bank loans to this company, so again, there exists the agency problem and the debt failure risk. Yeah, and it's important when we see the high transparency of we face with the high transparency of ownership, and when the banks have good collateral. So in this case, they can provide loans to the company. So the main barriers are legislation, as I have said, in the United States, and the main drivers are the resources that are easily provided by the banks, also risk capital and professional governance in many cases. Usually, it's either the companies with which the banks have long-term relationships, like Keiretsu in Japan, or some European banks, or the banks can specialize on taking over the companies with financial problems, and then the banks just improve their performance in some manners. And after this performance is improved, they can actually sell their holdings to their other companies for which the holding of these assets can be better source of synergy. So for banks, certainly the companies are not the core assets, and if they hold these assets, they have some some costs that are caused by the managing and governing the non-core assets. So if we look at the banking holdings here in Russia, I can give you two examples, quite fresh. So the first is the relationships between between Sberbank and Yandex that had taken place. So actually Sberbank acquired some part of shares of Yandex, actually 18% of shares, quite large block holding, because you know Yandex has diversified equity ownership in 2018, at the end of 2018. And this was viewed mostly like the hidden nationalization of Yandex. But the management of the company and the shareholders of the company, they worked a lot together with Sberbank to solve the problems of governance, actually. And they managed to create this Yandex Foundation that somehow protected the company from nationalization, but from the other point of view, it did not let Sberbank to realize its synergies from holding the equity of Yandex. And that's why after they were together for more than 1 year, actually 1.5 years, they separated. The separation has finished, this has been completed this summer. And actually nobody was happy because Sberbank did not realize synergies from holding the Yandex shares, and Yandex was all the time somehow fighting over Sberbank. And you know that later Yandex tried to take over the quite new story in Tinkoff. So this is a different situation actually, because in this case the company tried to take over the bank, but it did not lead to any results. We know this, yeah. The other case in Russia is Magnit. So with Magnit we had the different situation. We had the company that started underperforming. So Magnit has started losing its market position to its main rival, X5. And well, Magnit in 2017 faced with the problem of lowering growth rates, and also they claimed, they announced that they would not pay dividends after they started paying dividends a year earlier. So the shareholders, they were not happy. And that's why VTB approached the major shareholder and the founder of the company, and also the chief executive officer of the company, Sergei Galitsky, and they proposed him to sell his equities holdings. It was a little bit less than 30% of shares, and Galitsky has sold these shares to VTB. And later, so VTB was aiming at the long-run relationships with Magnit. They have claimed this many times. They also announced that they would have some projects where they wanted to include Magnit. For example, they wanted to create an ecosystem with the Post of Russia also and with Magnit. So they started to improve the performance of the company. They invited the new chief executive officer to the company. So first they invited Olga Naumova, who was the chief executive officer of Peterочка previously. And then, but Naumova stepped out quite quickly. And then VTB invited Jan Dzumin from Lenta, who is now the chief executive officer of Magnit. And actually the performance, the financial performance and the market power and the growth rates started improving. But at the same time, VTB decided to secure their investments, and they sold about 11% of their shares of Magnit to the private equity company Marathon Group very soon after the acquisition. Yeah, so they do not want to have a huge amount of non-core assets, despite they have some. Yeah, not only with Magnit. Okay. So this is about banks. So, and strategic investors. So strategic investors ownership, or strategic investors as market contractors in case of joint ventures or strategic alliances. So here we have huge benefits for their strategic investors as the owner of the company. Yeah, so these are stakeholder returns. So in this case, strategic investors, they can actually implement all the actions to increase the returns of the company, and as a major stakeholder, they benefit from these returns capturing. And also this is a growth, all the benefits of growth due to the economy of scale and of the growth of the sustaining and increasing the market power due to the growth of the market position. It is important at the markets with imperfect competition, because on the markets with perfect competition, there is no huge benefits of increasing the market power. The competition is still perfect. Yeah, a lot of competitors and no one has a huge power in the market. As for their market contracts, certainly if the strategic investor still remains not the owner but the market partner, for example, in joint ventures or in strategic alliances, there is much less possibilities to exploit advantages of integration. And that's why it's not a good way for them to become their stakeholders, the major stakeholders of the companies. So the main barriers are the weak institutions, certainly, and the bad investor climate in the country. Yeah. For example, there could be some restrictions for foreign investors to become the strategic investors, or the institutions in the company are weak. They do not protect the strategic investors also. And the main drivers are the resources, the need for resources, also their strategic investors bring some core competencies. They can increase the market position because they have the strategic vision. Also their capital, certainly professional governance, and the main interests are the synergy from acquisitions, so different parts, different types of synergy due to the acquisition. So the most common types of enterprises, so it depends on investor fit into strategy, yeah, but more certainly their company that strategic investors take over should increase the value of the strategic investors, so they should take their place in the value chain, and also they should be able to increase the market positions of strategic investors. For example, the trade-off between the greenfield and the brownfield. Yes, so you can open the new markets by yourself by creating an enterprises, or you can make a beachhead and enter the new markets through acquisitions. Yeah, if you act as strategic investors, if you bring capital, governance, some protection to the target companies, it is sometimes very successful. Again, I go back, I think I have told you about this example, but for Procter & Gamble, for P&G, it's a core strategy. So they usually enter the new markets through acquisitions. In all these acquisitions, they act as strategic investors. And for example, the acquisition of Gillette by Procter & Gamble that has taken place in the beginning of 2000s is a very good example. So actually, Procter & Gamble did not have any good assets on the market of shaving blades and razors and all this market, mostly for men. And the target audience of Procter & Gamble's was mostly female, but they really wanted to enter this market. And at the same time, Gillette was quite good. They were #1 on this market, but they had some other problems with their other assets. They had the problem with Energizer that they had, Duracell, sorry, they were the owners of Duracell brand, and they invested a lot in sustaining this brand. But this brand and this good actually was severe in the huge competition with Energizing, and they were losing in this competition, and they just deadly needed in some resources to maintain Duracell. And from the other point of view, they were under the huge pressure from Walmart, and about 1/3 of products of goods by Gillette were consumed by Walmart, so they were under the huge pressure of their main customer. So Procter & Gamble brought them capital, brought them managerial power, brought them resources, and due to this acquisition, they entered this new market. So this was a very good example of acting as strategic investor. Yeah. Okay. So the growth of the value of the company and the increase of the market position. So here, this slide, you can look, I will not stop at this slide in details, but you can look at the main factors that influence the stakeholder ownership for different types of stakeholders. So you can see that actually they have different roles in privatization. Their role depends on the firm-specific conditions, on markets and regulation, and also on the change in the later stages. And certainly the governance is changing. Yeah, we have discussed this. And here we can look at the governance cycle. I have mentioned this governance cycle at the introductory lecture. So there are some theories that support this idea of the governance cycle. So the choice of the governance structure is determined by two main factors. So these are the internal characteristics of the enterprise, like size, need of capital, information asymmetries, etc., and the external environment, so surrounding institution, market conditions, etc., the technology, etc. So both of them are changing. So enterprise characteristics change over the life cycle of the company, yeah? And these changes, they cause a change in governance structure. And each company passes through its specific governance cycle due to the life cycle changes, yeah? And the surroundings differ between countries, and countries in transition, they also have some specific features. So in transition in emerging markets. So we have some specificity of the governance cycle in developed countries and in the emerging markets and in countries that pass through the transition. Yeah. So the theory on the government side, on the governance cycle, actually there is no the solid theory. There are different approaches, the eclectic approach to the determinants behind ownership identity or concentration. So mostly there are two main theories. So the first is the agency theory that says that stakeholder-owner relationship is determined by the ability to govern the managers. And it is closely related, as we have discussed, to transaction costs in relation to contracting and monitoring, information asymmetries, and hold-up. Yeah. So this is always a trade-off between the market contracting and the ownership. And the second theory is a resource-based view or resource-dependent theory that tells us that stakeholders' owners' relationships is determined by the ability to supply critical resources to the company, like capital, governance skills, managerial skills, innovative ideas, sometimes specific types of their natural resources, and so on. Yeah. So these elements change over the life cycle of the company, and that means that the different types of stakeholder would have different benefits and costs of ownership over the different stages in the life cycle of the company. Yeah? And well, in general, we can look at the three main stages in the life cycle and how these stages are reflected by their governance cycle, yeah, in developed market economies. So first we have the startup stage, the early stage of company's development, where we're faced with the high asymmetries of information. So the market knows nothing about the company. It is non-transparent. And the company does not have a market experience of attracting the external resources. So usually the agency costs of outside ownership are high to the company. And at this market or at this stage, innovative ideas are often important, and that means that the founders of the company should have the control over the company to develop these innovative ideas and to create the market power of the company. So that's why in this case, in this stage, we face mostly with the entrepreneur management of family ownership. Yeah. When the company starts growing, so there are different stages actually which are united into the growth stages, but we usually have the early growth, the rapid growth, and the late growth, yeah, the sustainable growth. So the change in ownership and governance is caused mostly by the increased need of external capital, but also management skills and networks, and usually these capital is on the early stage supplied by banks, who often take the passive role, or by closely related investors like venture capitalists. Yeah, so venture capitalists, they take an active role and they take the many risks of the company. So on the early stage of development, on the early growths are mostly business angels. But some venture capital funds, they also reserve the part of their portfolio to the early stages of companies' development. So the capital is provided mostly either by banks or by closely related investors. And at the later stage of development, so the companies either go public, and we have the diversified ownership structure, or the company seeks and attracts the strategic investors. So the strategic investors, they require the co-control. In the majority of cases, these changes lead to the dilution of power, dilution of the founder's managerial power, and the fall of ownership concentration. And on the last stage, so it is crisis or restructuring stage, when the company started developing in the less growth rate than they're comparing to the market. So usually the company has some options in its governance cycle. So the first option is takeovers. So takeovers can be made by bank. So the debt equity swap. Or so the bank just changes its debt, its loans by their shares of the company, and the banks provide capital that is needed for their future development, if it is possible. Or the company can be the subject or the target of hostile takeover, which is not good, because usually hostile takeovers on this stage, they lead to the companies washing up the most valuable assets of the company without any contribution to the value of the company, or it can be taken over by strategic investors, which is the best option, I think so, because strategic investor has a strategic vision and it can use the company as a cash cow for its projects, and the company will capture the benefits of improving their performance, so improving growth rates and so on. Or it can be the defensive takeover by insiders, management buyout, for example. In this case, management takes the whole responsibility. It makes easier to take the managerial decisions, the governance decisions. And if managers have strategic vision, they can try to improve the company's performance and to increase the growth rates. Or the last option is you just close down the company, yeah, and divest from this company for all types of stakeholders. So now we know that the development of the company and the development of stakeholders' relationships with the company are quite complicated. Is quite complicated. The different types of stakeholders have different interests, and that the theory tells us about the trade-off between the ownership, the transaction costs, and the market contracting costs. So we know a lot about stakeholders, their interests, and we can implement our knowledge at the seminars. Yes, I would not start the new topic because there remains only 5 minutes till the end of our lecture. So I just wish you a good day and thank you for your participation in our lecture. So see you in a week. And with my group, I think we will meet tomorrow. Yeah. Okay. Yes, the question? It's not the question. Yeah. So thank you and goodbye.